Welcome back, everybody. This is Money Mondays.
Da-da-da-da. Welcome back to Money Mondays, everybody. The best real estate show on the planet.
At least the ones that are aired on Mondays, right?
We
At
do this
3:30.
every Monday at 3:30. No, all channels, all times. So,
Ooh, it's very bold.
no reality
Very
show
bold.
here. We do it real. So,
All right. Well, hey, what are we talking about today, man?
talking about the multifamily market, it has completely changed 6 months
It's
ago.
definitely changed.
We had our meetup last week, very successful meetup. And again, this topic kept coming up whenever I asked it. It kind of people started to really dwell on it and what's going on in the market, what's typical, what's not typical, what has changed. So we're going to spend some time and talk through all of that here today.
And I think
we're very, very active buyers and bidders, and so I think we have a very good pulse as a company.
that's true. That's very, very true. We're still active in the market. We're still looking to potentially buy at least one more deal, or partner, or try to take down at least one more before the end of the year, right? There's still deals getting done, folks. We just closed one last week. You Park Win, 241 units in Fort Worth. We're really, really excited about. We have one more that we're closing probably, hopefully, God willing, next week. We'll see. It might be pushed a little bit, but so we're still in the market, and we're still actively looking at deals too. So we do have a good pulse on it, but people tend to dwell. So I'm going to preface today. Look, there is a little bit of doom and gloom in the news, folks, but don't listen to everything that's on the news. That's why I cut the cord a long time ago with that stuff, right? Doom and gloom sells.
I thought the cord was cut whenever you were born.
Cut the cable cord, bro.
All right.
Come on,
Not
get
the
with
umbilical
it.
cord. Got it.
All right, so we're going to get right into it. Some of these questions came in before the show. How are we handling rising interest rates? It's like we've been hearing this for 6 months, but we can talk about it, right?
We're not handling them. They're handling us.
That's actually a pretty good way of looking at it, right? I think at the end of the day, you can't fight the Fed. So you have to go with where the Fed is going, right? So everybody, I think, in a lot of ways knew that interest rates were going to start rising. I think what really caught people off guard earlier in the summer was how quickly the Fed got on top of it and really started. And most people would say they didn't get on top of it quickly, and that's why they had to make up. But point of the matter is that their minutes are publicly, that's public information. You kind of have an idea of what they're going to do for probably the next 2 meetings. So you just plan accordingly, right? So when we were looking at deals back in Q1, we were underwriting deals from 3.5 to 4%, right? Now we're underwriting deals from 6.25 up to 6.75, right? Maybe in some cases even 7, depending on the type of asset, right? That's where you're at. Now, people are going to say, well, where are interest rates going to go? If I knew that, I'd have one of those like, shiny ball that you can kind of look into. What are these things called?
Crystal ball.
Crystal ball. Yes, see? This is why I have you around,
Ben's
dude.
ball would be pretty foggy, to be honest with
Help me
you.
figure out these things on the end of the sentences. But
I just looked deep into your shiny head.
thanks, buddy.
But I mean, that said, right, what are we doing on the structuring to help mitigate risk? That's
Well, okay,
probably the real question I think a lot of people want to talk about.
The point that I was trying to make with that rant is that you have to just underwrite to where current interest rates are going to go, and you have to look at the forward curve and just determine, hey, could they rise up higher? I think right now there's probably a little bit more pain. It's probably going to stabilize once the Fed realizes that they slowed down the economy, and then it's probably going to start trickling down. So when it starts trickling down, what are they trying to do? They're trying to stimulate the economy by putting more money into the economy, by allowing people to lend and loan and get debt at a cheaper price, right? That fuels economic growth, right? When you increase an interest rate, that's taking money out of the market, and that is essentially slowing down or putting a wet blanket on the market is what they're trying to do, right? And the reason they did this is because inflation was going through the roof, right? And when you have inflation that's going through the roof, the only mechanism that the Fed has is to increase the interest rates. They have a few more tools, but that's the big one. That's what everybody's talking about, right? So how do we handle that right now? We're obviously underwriting to where it's at, and we're putting a tight interest rate cap on our deals, right? And you're going to say, what the heck is a rate cap? I think we've mentioned it a little bit in the past, right? It's essentially a hedge, right? So your interest rate's going to be like right here, and you're going to have a tight cap that's almost right there in the money, right? Call it 1, 2, 3% strike. Look up Chatham Financial. They've got a whole interest rate cap calculator on their website. They're typically who we use. And if the interest rates go above that cap, they pay off the delta, right? Now people are going to say, well, that's probably pretty expensive. Yeah, it got a lot more expensive this year.
They are expensive. And I'll say, Ben said tight cap, and I'll actually say it a little differently. It doesn't have to be tight, which really leads to the third thing that we're doing, which is a lot of reserves. And so again, underwrite your deal effectively, right? If you underwrite at a 9% interest rate and you're going to buy a cap that it can't go above 9, by all means. If you have the cash to do it, that's okay too.
Yeah.
Right? And so it's really that balancing act, because on some of our deals, it's tighter than others, right?
Well, and some
we
of it is,
stagger it on the
I was also going to say some of that is dictated by the lender as well, right? They're going to dictate what the strike needs to be. And sometimes they're going to want your strike to be less than where the interest rate market is right now. So what does that mean? That means that you're in the money day one, right? So, for example, right now, the deal that we're buying, they're wanting a 2.5% cap, right? So we're going to be in the money essentially day one. But people are going to say, well, that's probably pretty expensive, right? Because they're almost going to immediately have to start paying you back. And yes, it does. It becomes very, very expensive, right? The other way that we've done this too, we've also had regional banks that don't require a cap. And in that case, and in both cases really, you just have the reserves. That pays off the delta between where you're wanting your interest rate to be and where interest rates truly are, right? But the cap is there to cap the interest rate from spiking to 10, and then you're stuck paying a note that you can't afford. The lenders don't want that, right? So they make you have those. You have to buy those ahead of time. You have to put them in place, usually through various banks. Goldman Sachs does it, SMBC, some of these other guys that use these as kind of hedging tools, right? And they cost a lot of money these days. Same cap that's $1 million today was probably $100,000 or $200,000 at the beginning of the year. So you can see it's gone up quite a bit, right? So next question, what are the trends you're seeing in the market? I would say the biggest thing that I've noticed, at least on the acquisition side,
pricing.
I'd say pricing has adjusted probably 10%.
10% is probably the fair number. Retrades as well are very common.
Retrades, extensions.
5% on those, 5 to 10.
Yep.
It's become now a buyer's market, right? As
Yes,
a buyer,
it's
you get to
shifting.
dictate. No more $1 million hard day
Yes.
one. Ask us how we know, right?
Yeah.
Now our next deals are not going to be anywhere that aggressive. I actually think, and Ben's going to turn red whenever I say this, our next offer, we don't have to have any hard money. I bet you. We'll see.
Or minimal. Like, it went from six-figure hard money to call it 25 to 50K.
Yeah.
Right? You're going to have a longer closing period. You might even start seeing financing contingencies. And I remember when I got into the business in 2014, that was already a faux pas back then. So it's going to be interesting to see if that shifts, right? And when I mean financing contingency, means putting into your offer that if interest rates spike to this or your loan amount goes below this, you can opt out of the contract.
Yep.
That's huge, But the other thing I was going to say is there's a lot less deals in the market right now. I think everybody's waiting and
You're starting to see a little bit of a trickle.
it is picking up, right? Especially compared to the summer, but it's still down the same time last year. And I'd say there's a lot less buyers in the market, right? So the brokers are actually calling people back. They're trying to wheel and deal and make things happen, right? They get it, right? Especially the seasoned veteran guys and gals that have been in the business for a while. They just know that this is just part of the cycle, right? They made fortunes the last 2 years, and now they're having to kind of scrape by a little bit.
It's funny to see the brokers kind of back off and essentially start to scrape the bottom of the barrel, right? To find deals that they
find buyers that are willing to actively buy in this market right now. I think there's a lot of people that are just sitting it out for a little while. Hey, I'm going to wait the next 6 months and see what happens in the market overall, and then I'll hop back in 2023. Or it could be a little bit longer. Like I'm going to wait until the back half of 2023. We don't know. Time will tell. Again, I don't have that crystal ball.
Yeah, and I think again, remember it's a buyer's market, folks. Do not have to get hyper aggressive. Most of these, to give you an example, I had a broker that said literally on a specific deal they would have gotten 30 offers, they got 3. So it's kind of the ratio, or 40 tours and they're getting 10. Yeah. So realize that. I think again, buyers are picking back up, so it'll improve a little bit, but you get to control the conversation and frame it a little bit more than you might have been able to previously. Previously, like brokers weren't even looking at offers that didn't have hard money. Now it's about a tit for tat.
Or they wouldn't look at offers that didn't have you were at ask was bare minimum and you really needed to be 5 or 10% above.
And actually, I'll add this. So for those of you that are buyers out there, submit an offer. Whatever you're at.
That's
you never know where it's going to stick.
That's a good point. So what he means by that is, okay, and we used to have this trigger, right? In our underwriting process, if it was below 90% of the ask, we would just nix it. We wouldn't even go after it. Now we've lowered that to 80%. And I'm thinking about maybe potentially lowering it even lower than that, right? So what does that mean? That means that, hey, whatever the broker's just throwing out there, it's kind of BS. You don't know if it's actually going to stick. They don't even know if it's going to stick. There's a lot of price discovery that's happening right now. And so, if you're close, you feel comfortable about the deal and the area and your business plan, put in that offer. You might get lucky, right? So again, stay in the market. There's good deals in every part of the market cycle. That's one thing. So what's going to happen in the future? I don't think anybody really knows. I think, again, interest rates are going to continue to tick up a little bit. They're going to stabilize, and then they're going to start coming down. When all that happens, TBD, I think the stabilization will probably start happening sometime next year. They might start ticking down 24, maybe even 25. So you're in for a little bit of a high interest rate environment for the next kind of, call it 12 to 24 months, and people just need to plan accordingly. Have good reserves. Make sure you have your interest rate caps in place.
Yep.
Right? So how are we addressing investors' concerns and hesitations given the choppy market? I mean, I think at the end of the day, the fundamentals of apartment investing haven't changed, right?
And I'd say just be front and center. Hey, here's what we like about this. Here's what we're doing to reduce risk. So.
Yeah, we literally, on our last deck, we put it right up front and center. I think it was like the second or third page. Like, these are all the risks. These are how we're mitigating them. And we got it right out in front and center. Because, again, if you're watching CNN or you're watching Fox or you're watching any of these news stations, all it is just doom and gloom, because that's what sells, right? But it's not all that bad, especially in the Sun Belt. You still have job growth, you still have population growth, you still have a supply and demand imbalance. And what do I mean by that? That means that there's too many people moving there and there's not enough housing, right? And so,
even that, what do we see on the jobs report Friday? There's still jobs
pretty good.
picking up, right? Better than expected, and so therefore the economy tanked. The market tanked. So not the economy, the market tanked. Let's be more specific.
So
again, the fundamentals are there, right?
I think you brought up something really, really good that I want to touch on, though. Don't equate the Dow Jones with the economy. They are two separate things.
Yeah, it's got to be the NASDAQ, folks, not the Dow Jones.
No, I'm kidding. That's what you can go with. But
stock market.
You don't equate the stock market to the actual economy. And I also want to make another point here. Real estate is very, very sub-market driven, right? So what might be happening in one part of one state isn't indicative of all that state or even all that region. And even within cities, there's paths of progress. And there might be, hey, you're on the north side.
No, it's funny. Yesterday,
there's a bunch of growth there.
Yesterday I drove up to the Woodlands, had dinner there. And it was just funny, just kind of, I was thinking to myself as I did the drive, I'm like, all right, so now we're in the not so good part of Houston, and now we're in the really nice part of Houston, now we're in the even better part of Houston. And, we passed by our property that we're buying, but it was just funny to, think about that and just mentally about how you just kind of know the part, it's a city where it is hot, and there's jobs moving there, and there's people moving there, and people are excited to live there, and the other areas that people are like, I wonder how's this area going to come along. So
so that's a good point that we need to drive home, right? It is sub-market specific. So, when they talk about the real estate and housing, most of the time they're taking macro data, they're taking a lot of the single family stuff and they're lumping it all into housing, right? Multifamily is still strong, folks, and especially in these markets where there's not enough housing and there's an affordability problem, that creates an incredible opportunity for people that are smart and know how to capitalize on that, right? So we get in front of that. We talk about the positive aspects of a multifamily investing, and that's how you kind of really you're able to get away from people's concerns and really kind of get them excited again, right?
Absolutely.
So my outlook for the sector, right, in 2023, what do you?
2023, I think we're gonna get a return back to, what's the word I want to use? Back to some normalcy. And what I mean by that, pricing is not going to go back to where it was. No. But I think it's this uncertainty, is the Fed are going to raise rates or not, that keeps on kind of screwing with things right now. I think that's going to be a lot clearer, right? The one thing I do want to say, the Fed is pretty clear about what they're doing. There's not a lot of hiding it or beating around the bush. So they are honest.
It's all public notes.
Yeah.
But
the previous Feds were a little bit more coy.
Maybe they're a little bit more close to the chest, right?
Right now, Jerome Powell's pretty blunt. Here's what I'm doing, and they're doing it. So fast forward 6 months, 8 months, I think a lot of that will be cleared up. I think inflation will taper. Maybe I'm wrong. I'm not an economist, but again, right now, what we have is a supply constraint issue. So again, as things normalize, right, demand is dropping. There's going to be a balancing act somewhere, right? And so I think that will happen. And so I think, I'm not saying rates are going to go down significantly or go down at all, but at least there'll be some normalcy. Because as an investor, we can always buy deals. It's just about understanding what the future looks like, and that's what gets people nervous, right? Things are going to get worse or better, right? And so if there's some stability, we can make some decisions on what we need to do, how to do it, and how to protect everybody.
Absolutely.
Versus like right now, where we have too much in reserves because we don't know what the future looks like, right? Which is great, but at the same time, we could make a better investment if we could reduce those reserves. So it's finding that balancing act between the two.
Yeah, I think Ferris hit it on the head. I think that there will be a return to this normalcy that I think we had seen, probably 14, 15, 16, where, you didn't have a whole lot of this cap rate compression. A lot of that happened just because there's a lot of cheap money, right? When you have less cheap money, it's obviously going to affect pricing a little bit, but a lot of that has already started happening, right? So the guy that's on Facebook saying that the world's coming to an end and he's sitting on all cash because he's going to just pick up great deals. He's going to
probably the same guy that's been saying that for 4 years.
Or been saying that for
a
probably
broken
since
clock
2008.
is finally right.
Yes, you're broken clocks, right twice a day, right? At the end of the day, that person is hoping that the bear market continues and that he's going to be the right guy. My point is that there's good deals in every part of the market cycle. You just have to adjust your underwriting. Right, the days when you could underwrite deals at 3.5 just aren't there anymore. Right, you need to be at 6.5. Yes. Right, but there's still rent growth. There's still a lot of good positive things that are happening, and I think right now you're already seeing a decrease in pricing from that that peak to where it is right now, which is about 10%. It might drop a little bit more depending on how much more aggressive the Fed becomes. But I think that, again, they've already outlined their plan, right? You got a couple more interest rate hikes this year. That's going to happen. It's already baked in, right? The market's already baked it in, right? And then from there, they're going to wait and see, right? They're going to see, okay, was this aggressive rate hike, did it equate to us slowing down the economy and slowing down inflation? If the answer to that question is yes, they are going to taper off or at least keep rates at a certain level. Once they start seeing the economy going down, interest rates will go down accordingly because they're trying to stimulate the economy, right? So I'm bullish on multifamily for the next 20 years because I think we have a big supply and demand imbalance, and that's not going to go away anytime soon. So 2023, we're still going to be buyers, right? In fact, we'll probably be net buyers. We're not selling.
Yeah.
I don't think we're selling anything.
I don't think we're selling anything in 2023. You never know.
We'll be net buyers, right? Yeah, unless somebody just throws a stupid offer at us.
Which we've had happen.
We've had that happen too.
I remember the deal. We're like, we're never going to sell this deal. You get a stupid. All right, let's sell this deal. So you never know.
So and I'd say for 2023, I still think that in these Sunbelt markets, you've got a ton of population job growth that's going to continue, right? Now is it going to be as much as it's been the last 18 months? Maybe not. But again, there's a reason why people are moving to Texas, they're moving to Florida, they're moving to Georgia, right? It's because that's where all the jobs are. Yep. So, and where is inflation going to be? I think it's probably going to taper off. Now it's not going to be down to this 2%.
As a real estate investor, would love it to stay where it's at because in the long term, it actually works better for you. But there's a lot of other negativity that comes with that high inflation.
It's a balancing act, right? So I think it's going to be a while before it gets back down to 2%. Right, and so I think right now it's at that 8%. Then it'll probably come down to 7%.
I read an article saying
it's going to hover about 4 or 5.
Yeah, their bet was going to hover at 4 for a couple of years, which I'm like, I can buy.
That's probably good enough. That's good enough for rent growth, but it's not.
But then I extrapolate that. So if it stays at 4, rates have essentially flown to
7.
9. Yeah, I mean 7, 8.
Yeah.
So the question is if inflation. So today inflation is like 9 or 10.
Yeah.
So rates are 7. So if inflation goes back to 4, where does that put rates, right? Some of this stuff.
I think that's where
270 over LIBOR, does it put it back at 5?
It comes back.
Does it put the prime, at 2 points?
Who knows, right? I think time will tell, right? But I think that, again, they've been pretty clear. If they can break the back of inflation, interest rates will start coming down accordingly, right? That's just how the Fed operates. Don't go against the Fed, folks, right? So, boom, we got through it. We made all of our hypotheses.
So Money Mondays, every Monday 3:30 Central. If people have comments, questions, thoughts, leave them. I can go ahead and answer them. Let's see, we did get 2, so let's go through these. First one, suggestion from Christian, put your laptop away, have direct contact with us. Hey, I'm sitting here reading questions and monitoring those, so that's kind of what I'm doing with the laptop. So it's being able to see the questions people have. So let's see, next one from Mark saying, should you write the offer close to the local comp? I would say, right now, your offer should probably be below the local comp, not the ask. Sorry.
I think that's going to be hard in commercial, right?
Is it how recent of a comp, right? I mean, is it a really comp? A commercial gets tough for a lot of reasons.
I would really kind of just, you have to keep a beat on comps and where things are selling at, but it's been such a fluid market. Right, I always underwrite or tell people to underwrite to where they feel comfortable getting investors' money in, right? So if that's a 10% return, then you can almost back into what your offer is going to be on any one deal, right? What we're saying is if the broker's telling you 10 million, even if it's 8 for us, because we're at 80% of the 10, I'm probably going to lob in an offer.
Ask us how we know.
Yeah. And so my point is screw what the broker's saying right now, because he doesn't even know, right? Again, they're just throwing out numbers just to see where people will bite at, right? And so if you've got a strong offer with a strong team and you feel good at that $8 million on a $10 million ask, I put your offer in, All right. Any other questions?
Any other questions, thoughts? Please go ahead and leave them. We'll answer them live here on
And if
Monday
you have
Monday.
any predictions on the future, we'd love it. Throw them in the comments, right? What do you think is going to happen for multifamily in 2023? Where do you think interest rates are going to go?
Otherwise, let's keep going.
All right. So we are talking Texas Multifamily Masters. Our webinar series that we do every month is coming up this Wednesday, October 12th. Mr. Anton Mattli with Peak Financing is going to be talking about multifamily real estate financing strategies in today's debt market. So this guy is the savant. He knows where the lenders are right now. He's lived through market cycles. He gets it, right? So he was happy to answer all of your questions, right? So check that out. It's this Wednesday. It's a virtual event, 7:30 p.m. Central Time, right? DisruptEquity.com/virtual meetup. We have those is it second Wednesday, Shanna?
Yeah, it's second Wednesday.
The second Wednesday of every month, we put one of these on. We have speakers, we have panels, we just talk, and there's also some networking components too. We do some breakouts as well. So typically get 100 people or so on it, and so it's a good event to kind of check in, even if you're at the house, right? It's a virtual event, folks. No excuses.
Yep.
But this is not a virtual event, and this is our MFIN conference that we're doing November 12th in Atlanta, Georgia. Oh my gosh, buy one, get one, $150 off?
Absolutely. Pricing will go up every hour on the hour, so the sooner you buy, the better.
Wow, on the hour.
On the hour.
Pretty aggressive.
But we're excited. It's going to be packed house. It's
great panels, great speakers.
Month, so.
Again, this is more of an in-person networking opportunity. And so we really love these events. We curate it, right? So you have enough time to kind of really develop those relationships. We've always talked about it on the show. It's people and relationships, and it's numbers, right, in this business. And so you got to get out there. You got to find your next partner, your next investor, your next deal, right? So check that out, mfinvestornetwork.com. Put in that coupon code DISRUPT and get that buy one, get $150 off on the executive tickets. Apparently, we're all sold out on VIPs.
Yes,
so no more VIPs, but it is in Atlanta.
Tried to warn people, they didn't believe it. So
Atlanta, Georgia, November 12th, coming up in about a month. So we're really, really excited about that.
If you have any comments, questions, thoughts, leave them. They had to get a couple, so I'll go through those. First one's from Christian again, saying houses goes down first, then multifamily. Explain.
I don't think that it's necessarily houses first, then multifamily. I just feel like, the interest rate environment for single family it's so powerful especially for first time home buyers, right? Because their payments go up
with
interest rates,
and so that actually pushes them to apartments.
Well, and it also decreases their ability to put the down payment down too, right? Unless you have the 0% down payment type situation, you're gonna have to come more money to the table to buy the same house that you're gonna have to pay more for each month, right? So I don't know if it's necessarily one before the other. I just think that there's a lot more things that we can control on multifamily versus single family homes, right? Because those are comp driven, that's subdivision driven.
Our answer is one's not a leading indicator of the other. They're a little bit independent. If in fact they might actually be inversely related. But again, it depends on a lot of other factors too.
I would also say the other thing too that I've always been a proponent of is if people can't afford to buy a house, or maybe they can't afford their house anymore, where are they going to go?
That's what
they're either moving in with their parents, their friends, or they're moving into an apartment, right? Because nobody's going to live under a bridge. So the apartments is always that backup that sometimes whenever the economy slows, you get actually a boost, in occupancy and maybe even rent growth too.
Absolutely. Let's see. Mark Clark says, nice thing to go to on Wednesday. Yeah, definitely good time.
Check it out.
Get out there, get educated. We're big proponents of that.
Anton, again, savant, he knows all about the debt market right now, and he is doing deals, so he knows what the lenders are talking about and what they're doing. So I think anybody that's got questions, come to that event.
Awesome. Otherwise, let's call it a wrap.
All right, so what's coming up next week?
Money Mondays.
Well, I know
3:30 Central.
Come on, what are we talking about?
Basically, is now the time to invest in multifamily real estate.
I'd say we can answer that right now, but yes, but we're going to dive into it a little bit more. But no, excited to talk about that. Tune in every Monday, 3:30 Central Standard, Money Mondays. Look forward to seeing you then.